Continuing with topic 5, paper 9, we're now going to look at section 3, hedging using currency derivatives. Now, whenever we're hedging, we will have access to the underlying asset, and in this case, it will be foreign currency. And we'll look at an example where an exporting company hedges its foreign currency exposure using an OTC put option. Now, the put option will give us the right to sell one of the currencies. Company is scheduled to receive 10 million euro in 3 months' time and is exposed to the possibility of the euro weakening against the Hong Kong dollar in that period. So you want to be able to sell the euro at a particular price, the strike price, so that if the euro weakens, you'll be able to exercise the put option. But if the euro strengthens, you'll be able to let the put option lapse. The market information that's provided to us, the spot euro Hong Kong dollar price is 11.75. Now that is 11.75 Hong Kong dollars per euro. We're given the Hong Kong interest rate, we'll find out why in a moment, 3% per annum, and a 90-day, 3-month euro put Hong Kong dollar call, so giving you the right to buy Hong Kong dollars by selling euros, has a strike price of 11.75, and the cost, the premium, is a percentage of the Hong Kong dollar amount, and it's 1%. What is the option contract we're involved in? We're going to sell 10 million euros at 11.75 Hong Kong dollars to the euro. And that will give us 117.5 million Hong Kong dollars. Now, the premium will be 1% of that 117.5, giving us a 1,175,000 Hong Kong dollars premium. Now, what's the funding cost? And this is where the interest rate comes in. It's the cost of borrowing the premium for 90 days. So we have to consider that. We may have the money, but this is the opportunity cost if we had the money. So we take 1.175 million Hong Kong dollars multiplied by the interest rate of 3% and take it for 3 months. So that's multiplied by 90 over 360. Gives us 8,812 Hong Kong dollars 50 cents. So the total cost is the premium plus the funding cost, which, as you see at the bottom, page 5.7, comes to $1,183,812.50. And there's the payoff diagram for the long put situation, top of page 5.8. And you can see that if the euro strengthens, we'll let the put option lapse and we'll just absorb the premium. But if the euro weakens, then we will exercise and we will take a gain in that position. But we'll have the underlying asset gain or loss to consider as well. And that's what we'll do with 2 possible outcomes. The first possible outcome is that in 3 months' time, the euro Hong Kong dollar rate is 11.6. Now, 11.6 means the euro has weakened. So we will exercise the put option. That's the reason we entered into it. And we'll sell the 10 million for the strike price, which gives us in total 117.5 million Hong Kong dollars. We receive that amount in Hong Kong dollars, but remember, we had the cost, the total cost of the option of 1,183,812.50. And so the amount that we receive in Hong Kong dollars is the amount from selling the euros less the cost of the option, and that gives us 116,316,187.50. So many numbers. So that gives us the effective rate of 11.6316, and that effective rate is better than the spot rate that we've just quoted of 11.6. So it has been beneficial to exercise the option. Now, the second possible outcome is that in 3 months' time, the euro Hong Kong dollar rate is 12. And so the euro has significantly strengthened. We will be very happy because we're selling euros. So we'll allow the option to lapse. We receive 120 million Hong Kong dollars, but remember, we've still got the cost option. We deduct that to give us net Hong Kong dollar received 118,816,187.50, and we use that to calculate the effective rate of 11.8816. In this case, it's not as attractive as the current spot rate of $12. But still, we must be happy that the euro has strengthened. We're in a better position than the 11.7 strike price in the option. Okay, so that's an example of hedging using currency derivatives. You're not going to get a question on the whole process, no way, but they may pick up certain points of that process to examine. We move on to section 4, trading strategies for currency derivatives. Now, this is where you're not looking at an underlying asset, an underlying currency. You're using currency derivative markets to make a profit. So we'll look at an example where a Korean investment bank decides to sell an option to receive premium income. So speculators will be selling options to try and make money. The bank believes the Korean won will not depreciate significantly, and if it does, they're going to be in trouble. Or, well, not trouble, they'll just lose money. And it's a 3-month period. So the bank sells $5 million worth of US dollar call won put. So whoever buys it has the right to sell won for US dollar at a strike price. If the buyer of the option exercised the option, the bank would have to sell the other way around, sell dollars and buy won. Following market information available, the spot is 815 won per US dollar. The Korean interest rate 7% and the 90-day US dollar call won put with the strike price of 815 sells for 1.5% the US dollar. What's the break-even point for the bank? Now, the break-even point will be the premium received of 75,000 US dollars plus the interest received on putting that money on deposit. And the interest received we see there is the amount of won that's going to be received, 61,125,000. We apply the 7% interest rate for 90 days and we get 1069687.5. So we add the premium received plus the interest from putting that premium on deposit. So the bank is going to receive 62,194,687.5. Now it's going to lose money when that premium plus the interest received is exceeded by the amount of money that it's going to have to pay out. So the break even is 62,194,687.5. That's the value of the premium it's receiving, plus the 5 million multiplied by the strike price of 815. So that's what it's going to have to settle, divided by the US dollars 5 million. And that gives the break-even foreign currency rate of 827.44. Let's look at the diagram. And we can see this is a classic put where we sell the put, we receive the premium, and that is a profit for us until the price of the currency goes beyond the strike price of 815. And if indeed the won strengthens up to 825, in fact, it's weakening, I beg your pardon, then the buyer of the put will exercise, and the point at which the bank will break even is when the rate is at 827.44. So the first possible outcome in 3 months, the rate is 805.25. US dollar has appreciated against the won. Option holder will not exercise. They'll enjoy the better rate. The bank will realize the profit of the premium and interest. The second possible outcome in 3 months is that the won depreciates against the US dollar and the rate goes to 830. The bank will be required to sell US dollars by the won because the option will be exercised. Therefore, bank will deliver the $5 million US, and this time will receive at the strike price of 815,4075 million. Lots of large numbers won. At the prevailing rate of 830, the bank would have received 4150 million. The bank will therefore suffer a loss of 75 million won on the position. And as the bank has received premium plus interest earned, the overall loss is actually 12,805. 312.50. It's highly unlikely you're going to get numbers of this size in the actual exam. Okay, that's the material on currency derivatives. I reckon you're probably going to get 2 or 3 questions on currency derivatives. So it's not a large exposure. At least one of the questions will be very straightforward and will involve the forward rate formula. Forward equals spot multiplied by 1 plus the interest rate of the numerator divided by 1 plus the interest rate of the denominator. That's almost guaranteed to be a question in the exam. And there'll be another couple of questions on currency derivatives. Then we come to commodity derivative products, and I would say you're looking at 2 or 3 questions from this section. Now, the underlying assets for commodity derivatives include items, as we stated there, such as gold, oil, corn, and soybeans. And the commodity derivatives have been around for many, many years and figure prominently in exchange-traded markets, but they're also traded over the counter. There are 3 commodity groups: agricultural, metal-based, and energy. Now, a favorite question in the exam is, which of the following are agricultural instruments that are traded as commodity derivatives? Or it could be metal-based, or it could be energy. It's a very straightforward question if you remember what they are. So let's look at the agricultural instruments. They can be broken down into grains. So we have commodity derivatives in grains, in softs, and in meats. The grains are corn and soybean. The softs, coffee, sugar, cocoa, and orange juice. And the meats, live capital and pork belly. So for example, a question say, which of the following are agricultural commodity derivatives? And they give you 1, 2, 3, 4. For example, you could have corn, sugar, orange juice, and pork bellies, and all 4 would be correct. So that's the type of question you're looking at in this material. They're primarily hedging instruments, but speculators can use them to try and profit from movements in the underlying commodity, as we say, such as orange juice and coffee. And some of the major agricultural derivative exchanges are Chicago Board of Trade, Dalian Commodity Exchange, Intercontinental Exchange, and we refer to that as ICE, and the Tokyo Commodity Exchange. Now, continuing with the commodity derivatives, metal-based instruments. We've got base, nickel, aluminium, copper, and tin. And we've got the precious metals, gold, silver, and platinum, and derivative products are provided for all of those. They are traded over the counter on exchanges, and the exchanges can be the Commodity Exchange, London Metals Exchange, and the Shanghai Futures Exchange. And then the third category, energy instruments, include crude oil and refined products. 2 categories of crude oil: West Texas Instrument, WTI, and Brent crude. The refined products include heating, gasoline oil, so that's heating oil, gasoline oil, natural gas, and electricity. And we're told the analysts watch crude oil instruments closely as they're seen as important economic indicators. They're traded over the counter and on exchange, the exchanges being New York Mercantile and ICE Intercontinental Exchange. Now, types of commodity derivatives. There are 4 types. futures, forward, swaps, and options. And there's a classic question that comes up as to which one is the best, and I'll cover that shortly. Starting with commodity futures. Majority commodity futures are traded for physical settlement. That is, you actually deliver the underlying commodity. There are some that are cash settled, but one of the reasons you get into these trades is the relative scarcity of some of the commodities. We're told popular futures trades are the oil, WTI, crude, and corn and soybeans. What's the downside of commodity futures? You have to put forward margin, initial margin and variation margin. So you do have to contribute capital when you're trading commodity futures. Bear that in mind. Commodity forwards, particularly popular, we're told, in metals trading. Most commodity forwards involve physical delivery, common for producers in purchase of gold to enter into forward agreements. However, forwards do involve a certain amount of management, we're told, and that's seen as a downside. 5.2.3 commodity swaps. Now, commodity swap, closer to interest rate swap, we're told, than a currency swap. Why? Because we don't swap the principals and we net off the cash flows. So simple commodity swap, fixed for floating, exchange of risk, commodity producer or consumer, and we'll see that in an example now, swaps floating risk for a fixed payment with a counterparty. Let's look at an example. Example of a commodity swap would be where a large electricity consumer, so we're looking at the consumer side, call it LiveCo, enters into swap with an investment bank, BankCo, to lock in a buy price against the floating price of electricity. So this is a major buyer of electricity. The electricity price can move. In return for the fixed price, counterparty BankCo agrees to pay floating pool price. And the diagram shows what's going on. So LiveCo is paying money at a floating price for electricity. It wants to get out of the uncertainty of changing electricity prices. And so it pays a fixed rate to BankCo, which in turn pays the floating price to LiveCo. So it's a fixed for floating swap. So that LiveCo receives the floating price and uses that receipt to pay the floating price to the electric utility. And so irrespective of the electricity price, BankCo will compensate LiveCo for the price they pay. And that leaves LiveCo paying a fixed rate to BankCo. Now, this would be used by LiveCo when LiveCo thinks electricity prices are going to increase and BankCo is willing to take the opposite position.